Only 35% of landlords report that their rental properties generate consistent profits year over year. Based on a National Apartment Association study analyzing more than 16,000 apartment units, the typical landlord nets around $2,070 per rental unit annually. In today's environment, mortgage rates on investment properties are hovering at 7.5% or above. The average gross rental yield across the United States currently sits at 6.56%. With all of that data on the table, here is what it actually means. You are borrowing capital at 7.5% in order to earn 6.5%. The bank already did that calculation before you signed anything. The real question is whether you ran those same numbers yourself. And this is not some fringe scenario playing out in a distressed market. This is the median American rental property purchased today, financed at today's rates and leased at today's going market rent. The math is inverted, and it has been heading in that direction for longer than most investors are comfortable acknowledging. There is a reason only 35% of landlords reliably turn a profit on their rentals. There is equally a reason that 65% do not. What this video is going to do is walk you through exactly where the money disappears, explain why the standard pitch surrounding rental property completely falls apart in the current environment, and give you the information you genuinely need before you put your signature on a mortgage for someone else's living space. Stay with me, because within roughly 8 minutes, you are going to encounter a figure that will permanently shift the way you evaluate every real estate opportunity you come across. Before we get into the numbers, there is a story worth telling. A man named Marcus, 42 years old, a project manager based in Jacksonville, a sharp, thorough, research-driven individual. In 2022, Marcus purchased a $390,000 single-family rental home. It had a 3-car garage, sat within a well-regarded school district, and the broker who sold it to him presented projections showing positive cash flow beginning on day one. Marcus was stepping into the landlord role. He was going to generate passive income. He was going to become his own financial institution in a sense. We will revisit Marcus at several points throughout this video because his experience is not an outlier. It is closer to the standard than most people realize. The central argument here is straightforward. Rental property as a mechanism for building personal wealth has been marketed to the American middle class on the basis of a set of assumptions that stopped being accurate around the same time interest rates stopped hovering near zero. The classic approach, purchase a home, rent it out for more than the mortgage payment, and pocket the difference, depends on a very specific set of conditions. Inexpensive debt, climbing rents, minimal vacancies, and manageable operating costs. In the majority of markets right now, none of those 4 conditions exist. What we have instead is a market that sustains the appearance of passive income while quietly dismantling the actual returns of investors who bought in under current terms. There are 4 distinct ways that happens. Each one is more damaging than the one before it. But before we get there, there's one central concept you need to carry with you through everything that follows. Anyone who has ever seriously considered purchasing a rental property has entertained the same mental image. Call it the vending machine fantasy. You acquire the machine, position it somewhere with consistent foot traffic, people insert money, you collect that money, and you never have to give it another thought. Passive income, financial independence, an early exit from the workforce. Here's what the reality actually looks like. A rental property is a vending machine that contacts you at 2 in the morning because the compressor has failed, a repair you are legally obligated to complete within 24 to 48 hours in most states, or face financial penalties. It is a machine where occasionally the person using it stops inserting money, and the law requires you to continue allowing them access for months while you navigate the legal process of removing them. It is a machine that demands a full internal overhaul every few years at a cost you never budgeted, and throughout your entire period of ownership, you are paying a bank $800 more each month than the machine generates in revenue, while banking on the hope that someone will eventually want to purchase that machine from you at a price higher than what you originally paid. That is the broken vending machine. Keep it in mind because it is going to resurface. In a few minutes, we are going to look at the exit side of the math, the side that real estate promoters never feature in their video thumbnails. But first, here is why the entry-level math is already broken in 2026 in ways that most buyers have not fully absorbed. The 1% rule is no longer functional. If you have spent any time in real estate investment communities, you know what the 1% rule is. The concept states that a property should generate monthly rent equal to at least 1% of its purchase price. A $300,000 home, therefore, should rent for $3,000 per month. That figure represented the bare minimum threshold that historically made positive cash flow achievable after accounting for financing. Today, in the majority of growing American markets, you are fortunate to find properties generating 0.6% to 0.8% on a $415,000 home, which is roughly the current national median according to the National Association of Realtors. A yield of 0.7% on a $415,000 property produces approximately $2,905 per month in rent. And that is if you can actually secure a tenant at that level. The national median rent currently sits closer to $1,445, though single-family homes in the mid-$400,000 range tend to command higher figures. Let us be generous with the assumptions. Say you secure $2,500 per month. Now look at the financing. As of early June 2026, the 30-year fixed mortgage rate on a primary residence runs approximately 6.5%. Investment properties carry an additional premium of roughly 1 to 1.5 percentage points because lenders consider them elevated risk. If your tenant stops paying and you face financial strain, lenders know you are more likely to prioritize your personal home over the investment property. So, your investment mortgage lands at approximately 7.5% on a loan of $332,000, which represents 80% of that $415,000 purchase price. That generates a monthly payment of $2,323, and that is strictly the mortgage. Not a single other cost included. $2,500 coming in, $2,323 going out on the mortgage alone, leaving you $177 per month before any other expenses. This is the moment the broken vending machine begins making its characteristic noise. There is an industry rule of thumb, one supported by enough empirical data that it is included in property management certification training, known as the 50% rule. Approximately half of your gross rental income will be consumed by operating expenses before the mortgage is even considered. Property taxes, landlord insurance, routine maintenance, vacancy periods, and accounting fees. This rule exists because it has been validated across hundreds of thousands of properties over many decades of data. Half of your $2,500 rental income amounts to $1,250 in monthly operating costs, or $15,000 annually. So here's the actual math. $2,500 in rent minus $1,250 in operating costs minus $2,323 in mortgage payments. You are at negative $1,073 per month. Every single month. You are not functioning as a landlord in any meaningful sense. You are serving as an unpaid property manager who writes a check to the bank for over $1,000 every 30 days. And Marcus? By the time 2023 arrived, Marcus was 6 months into owning his rental. His tenant had begun paying late. Then not at all. The eviction process in Florida took 11 weeks to complete and cost him, when you factor in lost rent, attorney fees, and property turnover expenses, just over $8,000. A single eviction. $8,000. Gone. Stay with us because we have not yet reached the element that makes all of this significantly worse. Let us construct the actual cost profile of that $415,000 rental. Not the idealized version, but the one built on real numbers. Property taxes first. The median effective property tax rate across the United States is approximately 1.1% of assessed value. On a $415,000 home, that is $4,565 per year. And that number is trending upward. According to data compiled by Doorloop covering 2024, property taxes ranked as the single largest cost increase reported by landlords, with 60% experiencing hikes and half of those landlords facing increases exceeding 6% in a single year. Next, landlord insurance. Not standard homeowners coverage, but landlord-specific policies. According to the Insurance Information Institute, landlord policies run approximately 25% more than a conventional homeowner's policy because landlords carry greater liability exposure. If a tenant sustains an injury on your property, you bear legal responsibility. Budget between $1,200 and $2,000 annually, depending on the location. Maintenance. The standard industry guideline is 1% to 2% of property value per year for routine upkeep. On a $415,000 property, that is $4,150 to $8,300 annually, and that assumes nothing significant fails. A roof replacement costs $8,000 to $15,000. An HVAC system failure runs $500 to $3,000. A plumbing emergency can cost $250 to $1,000 or more. These are not hypothetical scenarios. These are the line items that appear on every landlord's actual financial records sooner or later. Industry-wide maintenance costs rose 12% in 2024 alone. Vacancy. The national rental vacancy rate reached 7.3% in the first quarter of 2026, according to the U.S. Census Bureau. That represents nearly one full month per year during which you carry every cost with zero rental income. A 7% vacancy assumption alone removes $2,100 per year from your gross revenue before anything else is calculated. Accounting and legal. The IRS classifies rental income as ordinary income, not capital gains. Navigating depreciation schedules, Schedule E filings, and all associated compliance requirements demands professional assistance. Budget between $250 and $1,000 annually for an accountant. And now the cost that appears in almost no one's spreadsheet. Your time. Real Property Management conducted analysis on this specific point. The average landlord who self-manages spends 47.5 hours per year on leasing-related tasks alone, which includes finding tenants, showing the property, running background screenings, and drafting lease agreements. An additional 46.6 hours go toward ongoing management responsibilities. That is approximately 94 hours per property per year. 94 hours. More than 2 complete work weeks annually at a job that compensates you with variable stress levels and the occasional overnight maintenance emergency. If you value that time at $50 per hour, which is a conservative estimate for any professional seriously evaluating a real estate investment, that represents $4,700 per year in labor that never appears in the financial model. The same National Apartment Association study covering more than 16,000 rental units found that the average landlord generates $2,070 in net operating income per unit annually. $2,070. That breaks down to $167 per month, before taxes and before accounting for a single hour of your own time invested. You might think the problem is simply locating the right property, but the actual problem is that the financial structure does not work for the majority of people in the current environment, across most markets, financed at current rates. Finding the right property is the surface-level challenge. The interest rate and yield inversion is the underlying problem. Back to the broken vending machine. Here is the part that is genuinely worth examining closely, and the part that rarely gets presented honestly in real estate content. You have $83,000 available. That is your down payment on the $415,000 rental. Now suppose that instead of using it as a down payment, you deposited that $83,000 into a broad S&P 500 index fund and simply left it alone. From 1992 through 2024, the S&P 500 generated an average annual return of 10.39%. Over a 10-year period at that rate, $83,000 grows to $223,000. You made no subsequent decisions. Nobody contacted you about a failed water heater, no tenant issues, no maintenance calls, no legal fees. Now compare that to the rental scenario. You deployed $83,000 as a down payment. You are losing approximately $1,000 per month in negative cash flow. Over 10 years, you have contributed an additional $120,000 to the property simply to cover the gap between rent and true total costs. You are also counting on property appreciation to rescue the investment. And here is where that assumption becomes problematic. In 2025, the national median home price grew by 1.7%, according to Redfin data. 1.7%. At that appreciation rate after 10 years, your $415,000 property is worth approximately $500,000. That is $85,000 in appreciation, set against $120,000 in negative cash flow and carrying costs. You are in a deficit position before you even account for the cost of selling. And selling costs are not minor. When you sell an investment property, you are looking at 6% to 10% in combined closing costs, realtor commissions, and transaction fees. On a $500,000 sale, that strips out $30,000 to $50,000 immediately. Then, because you have not lived in the property for 2 of the previous 5 years, which as an investor you have not, any profits are subject to capital gains taxation. On top of that, there is depreciation recapture to consider. Every year you own the rental, you claimed a depreciation deduction on your taxes. When you sell, the IRS recaptures all of that depreciation at a rate of 25%. The total tax burden on a rental property exit is genuinely substantial and almost never factors into the original sales pitch. Here is something else worth noting. Even REITs, meaning publicly traded real estate investment trusts that allow you to hold fractional ownership across thousands of properties through a single ticker, returned 11.8% annually from 1972 to 2019, according to Morningstar data. That is 11.8%, outperforming the S&P 500's 10.6% over that same window. You could have secured real estate exposure, income backed by rent payments, broad geographic diversification, and professional asset management with zero late-night maintenance calls by simply purchasing a REIT ETF. And you could have liquidated that position in under 15 seconds if your financial circumstances changed. A rental property, by contrast, is an illiquid, concentrated, actively managed wager on a single address in a single zip code. And you have no reliable way of knowing how that zip code will perform over the coming decade. Marcus, by the way, learned this the hard way. Jacksonville, where he made his purchase, fell within the group of Sunbelt markets that experienced price declines in 2025. His $390,000 property appraised at $372,000 by the end of year 3. He was underwater on appreciation. His cash-on-cash return, after actual documented expenses were recorded, was negative. He was not accumulating wealth. He was providing maintenance services at no charge while paying a bank for the privilege of doing so. Now here is the psychological layer that compounds all of this, and it is the dimension that is genuinely fascinating from a behavioral standpoint. Rental property activates what behavioral economists refer to as tangibility bias. People assign greater perceived value to investments they can physically interact with. You can drive by your rental property. You can point to it from the street. You can say with certainty that it belongs to you. You cannot drive past your index fund holdings. They do not register as real in the same emotional way. And because the asset feels tangible, you construct a cognitive narrative around it. The story of passive income, of legacy, of building something that outlasts you. That narrative is powerfully compelling. It is also, for the majority of investors, empirically inaccurate. There is a second psychological dynamic at play, one that researchers identify as overconfidence bias in personal competence. Investors consistently believe they will outperform the average landlord. They expect to attract higher quality tenants, maintain lower vacancy rates, and handle repairs more cost-effectively because they know someone who can do the work cheaply. And some do manage that. But the math does not respond to confidence. It responds to interest rates, market rent levels, vacancy trends, and unexpected expenses, none of which are within your control. The individuals who genuinely profit from rental real estate are overwhelmingly those who purchased before 2020, or who operate at significant scale with professional management infrastructure and rigorous underwriting discipline. They are not the first-time individual investor purchasing their initial rental property in 2026 based on content created in 2019 when conditions were fundamentally different. And here's something that almost never enters the conversation: the path dependence problem. If you purchase a rental property and it begins generating monthly losses, your exit options are painful and expensive. You cannot liquidate the position in seconds the way you can with publicly traded securities. You must list the property, negotiate terms, wait through escrow, and absorb the transaction costs already outlined. You are locked in, and the longer you remain locked into a deteriorating position, the more the losses accumulate. The broken vending machine does not repair itself while you wait for the market to shift in your favor. Let us construct a concrete, replicable scenario now so you can apply this same analytical framework to any property you might be evaluating. The property: a $420,000 single-family rental in a mid-sized U.S. market. You put 20% down, totaling $84,000. Your loan amount is $336,000 at the current investment property rate of 7.5% on a 30-year fixed term. Monthly mortgage payment: $2,349. You secure a tenant at $2,500 per month, which represents a gross yield of approximately 7% of the purchase price on an annualized basis. That figure already exceeds the national average gross yield of 6.56%. You are starting from a better-than-average position before any expenses are considered. Now the actual costs: property taxes at 1.1%, $3,850 per year, or $321 per month. Landlord insurance: $1,500 per year, or $125 per month. Maintenance reserve at 1.5% of property value: $6,300 per year, or $525 per month. Vacancy allowance at 7%, $1,400 per year, or $117 per month. Accounting fees, $600 per year, or $50 per month. Total operating expenses, $13,650 per year, or approximately $1,138 per month. Rent of $2,500 minus operating expenses of $1,138 produces net operating income before debt service of $1,362 per month. Subtract the mortgage payment of $2,349, and your monthly cash flow is negative $987. Annual cash loss: $11,844. That is before property management fees, which, if you hire someone, typically run 8% to 12% of monthly rent and would add another $200 to $300 per month to your losses. Before any major capital expenditure, before any legal fees, before the value of your time. Now the opportunity cost comparison over the same period. Take that $84,000 down payment and place it in a broad market index fund earning 10% annually. 10 years later, it has grown to $218,000. No phone calls, no maintenance, no tenant relations. Then take the roughly $987 per month in negative cash flow, the money you were effectively paying out of pocket every month, and imagine instead that you had invested that amount into the same index fund. At 10% annual returns over 10 years, approximately $987 per month compounds to roughly $203,000. $218,000 plus $203,000. You are looking at more than $420,000 in the index fund scenario, set against a rental property scenario where you are dependent on home appreciation, simply to approach breaking even on your losses, and where selling costs and tax obligations would consume a meaningful portion of whatever appreciation you did realize. At this point, someone will inevitably raise the following point: principal paydown is being ignored. The tenant is gradually paying off your mortgage balance. That observation is accurate. However, on a 30-year mortgage in the early years, the amortization structure means you are paying primarily interest. Of roughly $28,000 in annual mortgage payments during the first decade, approximately $23,000 is interest, with only around $5,000 reducing the principal balance in the early years. So yes, the tenant is contributing to mortgage paydown, but the vast majority of those payments are servicing the bank's interest, not building your equity. You may believe that principal paydown is the investment's saving grace, but the amortization schedule reveals that in year one, roughly 90% of every mortgage payment goes toward interest. You are essentially renting the loan itself from the lending institution, the broken vending machine channeling its output into a different machine entirely. Three things to take away, because if you have remained engaged this long, you are not seeking permission to be passive. You want a real framework. Here it is. First, run honest numbers before acquiring any property. Do not base your projections on the most favorable rent estimate, an optimistic vacancy assumption, and the low end of the maintenance range. Model using the median rent in your specific market, a 7% vacancy assumption grounded in current census data, and 1.5% of property value for annual maintenance. Then apply your actual mortgage payment at current investment property rates, not rates from a case study published in 2020, and determine whether the resulting figure is positive. In most markets at current prices and current rate levels, it will not be. That is critical information. Do not dismiss it. Second, if you are committed to including real estate in your investment portfolio, evaluate REITs before evaluating individual properties. You can hold professionally managed real estate diversified across hundreds of properties and multiple geographic markets through a publicly traded fund with full liquidity and without ever managing a landlord-tenant relationship. The returns from 1972 to 2019 exceeded the S&P 500 by more than a full percentage point on an annualized basis. A well-constructed, low-cost portfolio does not exclude real estate exposure. It captures that exposure efficiently through instruments that will not contact you at midnight. Third, account for your time explicitly. Every hour you dedicate to managing a rental property is an hour unavailable for everything else. If you have a career, a business, and a family, which describes most people seriously considering this type of investment, you likely have all three competing for the same hours. 94 hours per year per rental property is not a negligible commitment. It represents more than 2.5 weeks of your life annually engaged in labor that was never priced into your return calculation. Price it honestly. If the numbers do not hold up when you factor in your time at a reasonable hourly rate, that investment is not passive income. It is a second job with worse working conditions and an unresponsive supervisor. Here is the part of Marcus's story that was withheld at the beginning. He is not financially destroyed. He is not in crisis. The property carries real equity, and Jacksonville, despite experiencing a price decline, will in all likelihood appreciate meaningfully over the long term. Real estate held over extended horizons of 20 to 30 years tends to resolve positively. The problem is not that real estate is categorically a poor investment vehicle,